Okay, welcome to Trading with Market and Volume Profile course. This is going to be chapter number 14, the 5 auction market theory rules. This is going to be one of the most important chapters in the course, as we're going to go over the five basic rules for how we expect price to behave around certain areas in the auction market theory. This is very related to also how you see movement in volume profile. So I'm actually, before we dive into this 5 rules, I'm just going to bring this up here and show you this. I'm going to include this attachment in this unit. This is basically a template that I had made. You can see back in 2022 when I was putting together the day trading course and also doing an overhaul of my trading with price action and volume profile course. So this is a template for how we can expect prices to move within the volume profile, within the high volume nodes, which are these areas in black, obviously, and then the low volume nodes, which are this little purple highlighted areas where volumes are cut. And so you can see how we expect, for example, transitions. If we accept into a node, what I've been talking about, how I love on a downtrend to look for fades to go short on the top side, targeting the point of control and then the bottom edge, etc. Over here you can see this one's is like an over under pattern, which we're not going to go in, but is one of the main patterns I talk about in my other courses, etc. Okay, so I'm going to leave this document so you guys can download it. And just because it says volume profile, this is mainly I made this specifically when I was talking about volume profile, but you can imagine that this is also a market profile, okay? So we would be measuring time versus price instead of volume versus price, but it's very similar concepts. When we find acceptance in another market profile accumulation area, another high time edge, a ledge, etc. Okay, so that's going to be there, and what we're going to talk about now is going to be very closely related to that. So, and the same market profile rules that we're going to be looking at are also applied into volume profile. Price interacts the same way when it comes to this high volume node edges or this market profile areas. So rule number 1, if price accepts a balanced area, and by balanced area, you can understand that we're talking also in in volume profile terms. This is going to be a high volume node. So it's going to be where we see accumulation. This is going to be what we call the balance area, with the point of control as the ultimate balance, both in market and volume profiles. So it's likely to revert to the other side. Price often retests the edge of the balance area before moving to the other side, okay? So let's look at a diagram here, and basically this is what we mean. We have a high volume node or a balance area right here, and you can see this gray represents the valley area for this profile here. And when price comes in, if we accept into this area coming down, then we expect a touch on the edge of it to make a transition into the lower part. We would always pay attention to the point of control as well as a first target, but then we will be targeting the bottom area of this, okay? And the same thing, if we have a market that is in an uptrend, if we put in a market profile or a volume profile, then you would see that, these areas are going to be the ones that probably have accumulations of volumes right here, because as you know, the areas with singles or gaps or low volume nodes are the areas where we expect support and resistance rejections. And so when price accepts into an area of balance like we have over here, then we expect a rejection from one of the edges and a transition into the other side, especially if we're going obviously with the trend in this case. So in this case, if we're in an uptrend and price accepts in a balanced area, any move to the bottom of that balanced area or high volume node, etc., then we would expect support to hold here and then the upper edge to be next, since we're going to be making higher highs and higher lows. So right here, for example, this is the SP 500 futures. This is a longer time frame. This is a 4-hour. And this is an example with a volume profile. But again, this rules applies equally to market as well as volume profile. And you can see we had this accumulation here. So we formed this large high volume node. And then we had a down move right over here. Then when market starts doing this rally again, we have a very bullish candle right over here, which gets us right back within this valley area. And then you can see how we make a move back into this previous area, support, resistance, and now support. And then we make a quick move to the top side of this balanced area that we have right over here. Okay, here's another example, but looking at it with a composite market profile. So we have this market that had a move down. Oh, let me go back. Had a move down. Then we ended up printing 8 days of mostly sideways action in this range, and then we had a breakdown from here. So if we make an 8-day composite, you can see how we have now this big composite, and I've highlighted in this blue area our valley area. This is something that I like to do when I do my trading analysis. I look over all my, higher time frames, etc. And when I make my composites, I like to mark off the valley area with some kind of background or rectangle. And I just extend it all the way to the right so that in the future, I can use that as an area to reference. So in this case, if we go into the next slide, we can see how this is coming from this 8-day composite. This is the valley area for that composite. We had broken down, and now we had this news event, which caused us to have this really big move up. And what do we see? Price comes up, accepts, and closes within this area. And then you can see how for the next few sessions, we start just testing the edges and pretty much balancing again within this area. But you can see right here how we came up into it. We had this down move, which almost touched the edge. And then from there, we transitioned through to the top area of this balanced area that we're tracking. Okay, here's another example. This is a 4-day composite. So again, you can make an extension of this. In this case, the valley area would be here, but you can also see that there's a very clear edge right in the middle of this, and that's why I put this extension from this edge. And you can see how we had this big move. We closed within the balanced area of this composite, and then we just had a little pullback into these edges right over here where the time and volume interest dropped off. retest, and then we just pushed up into the upper edge of this. Okay, rule number 2, if price is within a value area, it is expected to reject the edges and get choppier. Okay, so basically, like I mentioned already, actually on the first rule, when we accept in an area where there's a balance, we tend to see that price is going to get choppier. This is why I always say it is not recommended to get into positions at the points of control. Like if you see a market that is sort of like bouncing around in a range within a balanced area or a high volume node, you do not want to be opening trades in the middle of this, because as we know, the point of control acts like a magnet area. This is where the most trade is facilitated in the auction between buyers and sellers. So we are going to get choppier here. We want to look to position ourselves around the edges, either buy at a discount or sell at a premium. And ideally, we want to take the context of the trends, and then we want to try to get in on retracements of that. But if we have a market that comes and it's doing this, and suddenly we start, pretty much consolidating and trading in this range, you do not want to be opening positions here because it's not very clear what we're going to do. It's better to wait, either keep buying the range low support, or wait for a clear breakout and then shift in market structure here to the downside, and then you can look for a retest short or a breakout and then retest long, for example, or again just keep fading the edges. That's pretty much the basic guidelines on this. So we have right here rule number 2. You can see here we have 6 days where the value areas are pretty much mostly lined up. And so in this case, you do not want to be opening trades right around this middle area because we're pretty much in balance. You can see that price constantly goes up to the highs, then comes back to the lows, or comes back into the lows of this and then reverts back to the mean, etc. So until we have, in this case, now we have an open up here, a push, and then we do have a close out of balance, then now this is indicative that, okay, now we might be starting, an impulse trending move. Here's another example. We had a big composite with a clear value area here. And then once market finally closes near the top, opens outside the next day, now we start to finally see some trending move. But if market would come down back into this area, most likely we are going to get stuck here for a little while, balancing out again within this big value area from this composite. Okay, here's another example, just looking at a simple candlestick chart. This is the daily Bitcoin, and you can see this is pretty much what we've talked about, value migration, where we have several weeks of sideways action. We have a breakout, and when market comes back here, we start getting again choppier within this previous areas of values. And you can see how right here, it's pretty much just fading the edges until we get a clear breakout. And you do not want to be, in this case, trying to get around the middle of these areas because you can see how choppy all this is. Here's another example where we have on the NASDAQ market. Here's the regular trading session. We watch a pretty balanced profile with a big valley area right here. We opened up on the extended hours, and you can see how we had a push down, but then mostly we got very choppy right around the middle. So we had a push down, then we came back within this balanced area, and now market just pretty much ended up really choppy and still closing around the middle. So when we're in balance, you want to just be paying attention mostly to plays around the edges. Rule number 3, when price accepts outside of balance, it's likely to become imbalanced and seeks new value. So this is basically a breakout. Often a point of control from another balanced area that acts as a magnet. Okay, so here, this is also included in the template I show you from 2022 with the volume profile transitions. Similar concept here. Points of control acts as magnet areas, as this is where there has been the most interaction between buyers and sellers. And so when we have a breakout from a previous valley area, you can see we're on a downtrend right here. We broke down, retest. Then the next target we'll be looking at is the point of control of another valley area down below. Now, I've read some people and they've asked me, do we take trades off of points of control? You know, there's no yes or no answer. It is possible for points of control in the next valley area to reject price, and it does happen, but it would not be a trade that I would just blindly put a limit order here to buy, because this could go all the way into the bottom edge of this value area. So points of control do act as rejection points, especially when coming from one value area into another, from one high volume node into another. But I think it should be more discretionary. We should look into here, you know, for in the lower time frame for any micro bullish structure. Look, if you're using order flow, check out the footprint to see if there's selling absorption, etc. But it is possible to get fades off of the retests of points of control at other valley areas, but mainly you want to use them as guide to as targets. Okay, and so here, this is a volume profile example in the NASDAQ on the daily time frame. This volume profile, I have it from here over to here, and you can see we have a big valley area right here, and then we had some smaller and larger high volume nodes, and you can see how right here we broke market structure to the downside because we closed down below here. We did form this big edge over here, which acted as support, but now we're making lower highs, lower lows. So when we're pulling back here, we're expecting a lower high to happen over here. And you can see the point of control from this entire move up here that we had was exactly where price pulled up. We made our lower high right at the point of control, and then we push down more and we make another lower low. Okay, so that's an example of that. Another example right here. This is why it's important, to track previous sessions, especially in futures. If you're using extended and regular hours, regular market hour profiles are always going to have more significance just because there was a lot more traded volume and activity on them. And you can see right here, we had this profile from this session. We'd had a double distribution. Then we had this extended hours, which was pretty balanced, but we did close near the highs. So we did close within this node area right here. But then you can see on the next regular trading session, we opened right here. We had a quick impulsive move. So this was an open rejection reverse move where we open up here, very impulsive move into the naked point of control from the previous RTH, and then we reject, and we had a very impulsive move down, which broke both lows from this previous sessions. Here's another example. This one is in the NASDAQ market, and you can see again we have individual session profiles, and I have the extensions of the point of control and the value area high and lows, and you can see we're making a downtrend. Now we bottomed, and now we start coming up. And then on this last regular session, we had our open here. We had a quick flush down, which got bought up. We started moving up, and then target right into this naked point of control. And then that point of control then gave us a little rejection, and we closed right over here. So, this move is not like a huge move, but if you're trading futures with leverage, this little trade could be, would be a great trade to pull off during the day. So you can see how, and not just fading, but also as a target. If you're over here and you open the session, we push up, we push down, and you see we're making higher lows, and you get long, around here, this will clearly be one of your main targets to close out your position at a naked point of control that you have above. Here's another example. This is just with weekly volume profiles, and you can see right here how we can use, in this case, periodic profiles, and we have the points of control, which then we can use in the future as targets. If we just extend these, you can see how all this would have provided good targets, and a lot of them gave us some nice fades actually from them. But this is how, in this one, for example, hasn't been tested, but we would just project it into the future. And if this market starts breaking down, this is another one that hasn't been tested, then we would be tracking, this naked points of control as well. Rule number 4, if price has a strong reaction when testing a point of control from another value area, then it can break rule number 1. So rule number 1 stated if price accepts a balance area, it is likely that it would target the opposite side. Okay, and this is what I was talking about before, about rejections or fading points of control. If the move has a strong enough reaction off of a point of control, it can just bounce off away from this value area, because most of the time we would expect this to test here, and then we look to short the top edge targeting the other side. But if we get a strong enough reaction off of the point of control here, price could break out and just go back into the previous value area where it broke down from, for example, or even just bounce, test this next one, and then come back down, etc. Okay, but that's why it's very important, our main focus of attention on this balance areas are going to be the points of control and the edges, and then we're just going to be playing breaks and retests, or we're going to be looking for acceptance and fades from the edges. So if you go look at some examples, we can see right here, we had this is the Bitcoin 1 hour chart. We had several days of mostly sideways action here, building value. We broke down from this, and then we came back up and pretty much retested the middle or the point of control area from this. And instead of testing and doing like this and accepting and continuing balancing here, we just had a straight up rejection and then a breakdown again. And then we continued making lower highs and lower lows. So another example, we have this big composite, and you can see we have this big balance area right here. We have our point of control. Market broke down. Then we come back up into it. We hit the point of control. And instead of hitting it and just start accepting and balancing within this balance area and targeting the other side, this case we just came, we touched it, and then immediately rejected, and then market came down and started seeking lower areas of balance at lower prices. And this is this is the same thing, but looking at this area on the 5-minute chart, just so we can see some more detail. And you can see right here, this is the point of control and the valley area from that big profile. So this valley area, I extended it into the future, and we have this is the area in the point of control. And you can see on the lower time frames how we had a very nice over under pattern. Market pushes up, down, up again, down, and then we go. If you want to look at this in classical chart pattern terms, this was basically a head and shoulders. We had our neckline right there, and we just had this strong reaction off of the point of control, and then we just broke down on the looking at it from the lower time frame, and then we did not accept and build time and value in this balance area, but we just continued searching for lower values. Okay, here's another example. This is in the gold US dollar 4-hour chart using a volume profile. You can see we came up. We had formed a high volume node right over here, and we had a big impulsive move up. We came down right into the point of control from this high volume node, and instead of coming up and staying within this, testing both edges, we just had a very strong reaction and rejection from these balances. And then you can see we searched out this higher balance area, and then we eventually started forming another high volume node right over here. So if the momentum is strong enough, we can reject right off of a point of control from a balance area and seek out acceptance back into the previous balance area. Here's an example on Ethereum US dollar or Tether on the 1-hour chart. Same thing, we had market coming down. We have this naked point of control here, and market just had this impulsive wick that literally just went right into this naked point of control and then immediately rejected, and we came back down into this previous area of balance. So again, markets 70 to 80% of the time are going to be consolidating versus being in a trend or an imbalance. So what we're tracking with this is simply where price is finding acceptance. The more time and volume it accumulates in an area, the more likely it'll become sticky, have more friction, and act as an area of price attraction in the future. And rule number 5, if time volume build up at the edge of a balance area, then the expectation is for a breakout. Okay? And you can see on the diagram, if we start consistently coming and hitting an edge of a balanced area, we can expect this to have a breakout. Now for this, when I see this, I always like to go into a footprint chart just for confirmation too, to see if there's actually selling absorption, because it is possible for this to then just reverse if all these aggressive sellers are getting absorbed. But most of the time, if we see this applying pressure, lower highs, and just a same level of support hit again, it will most likely cave. Okay, I'm not like huge on classical chart patterns, but I would say that the ascending and the descending triangle is probably the pattern that I like and use the most from those, because it makes sense. If you have a market that is trending up but is finding constant resistance at a same level, you know the rule that the more a level gets tested from the same side, the weaker it becomes. One of the fallacies of trading that a lot of novice traders starting out learn is that the more a level gets tested, the stronger it is. And that's not true. The more a level gets tested from the same side, that means each time this is getting touched, more and more resting orders to sell are getting executed, and the DOM, or the depth of market, is getting weaker and weaker unless there is a huge seller that keeps refilling limit orders to sell here. Eventually, the aggressive buyers are going to overwhelm the resting orders to sell here, and then we're going to see a breakout and the same scenario on the downside. You see lower lows being made and price hitting this support level. We expect it eventually to just cave through and go seek out the next area of balance. So right here, for example, we have this profile. We have this valley area here, which I've extended with this blue area. And you can see how we have 1, 2, 3 days all hitting the top side of this valley area here. We're making higher lows until eventually we have a close through this. This is a holiday, so that's why it looks a little bit messy, those two profiles. But then you can see we have a confirmed breakout here when we have a close at the highs on this day. Over here, Ethereum US dollar tether 1 hour. So again, this is just a very classical ascending triangle. Higher lows and the same resistance level getting hit over again until finally we have a big volume injection of buying and we have our breakout. Over here, we have again an area where we had 2 days in a row now. And if you look at it on the profile, then this would look like a double top. We have 2 different days making a high at the same level. And then on the third day, we finally come and we get this injection. And you can see higher lows. So pressure is on the buy side here. And then eventually we see that breakout from the value. This is an example on this same example. It's this one right here, but seen on a 5-minute chart. And you can see how this was a very bullish session and we made this high. Then the next day we attempted several times during the next regular trading hours again. And then finally here on this extended hours, we came again and rejected. And finally here, this was most likely a news-driven event because of this big candle, but we had the release and the breakout after we've been continuously putting in higher lows. Okay. Okay, so let's just go on the charts here and just look at a few examples of all these rules. This is the Euro US dollar market, and you can see right here we had a pretty balanced area right here before we broke down, and then we came right back up into here. So let's just make a composite over here. Merge with prior, merge with prior, merge with prior, merge with prior, and I guess I'll do one more. Merge with prior. So this is a 6-day composite, and you can see right here how we have our valley area. Let me just put mark this off here. Right there. Let me change the color of this. Okay, so this is our valley area from the composite, and you can see how price came in, got in, and then on this, let me zoom in so you can see this better, but you can see right here how we came in here on this TPO, push back on the next one, and then we just pushed up into the other side. So basically the rule is when you accept into a valley area, price is likely to revert to the other side. And a lot of times you're going to see, like in this case, once you accept in, a retest of the edge and then continuation. And again, like I said, first you target the point of control. You can actually see we had a little stall at the point of control, then we push back, and then we targeted the other side. So this was like this. In this case, we came up to the point of control, came back down to the bottom edge here, and then we came into the top edge of the balance area. Okay, and now let's just delete this here, undo merges on profile, and I'm going to put this back together, and let's look at an example of rule number 2. Okay, here, rule number 2, that if we accept into a balance area, it is expected the price is going to become choppier and reject the edges. Okay, and we can see that over here, we can see how we had this balance area, big move down, we came back up, and now again you can see that we do get choppier in a sideways consolidation before we have the continuation. So in this case, if we just do a merge of this consolidation or this overlapping of valley areas that we had up here, and we extend this valley area right there, you can see that once we find acceptance back here, market just starts chopping and rejecting the edges of this back and forth until finally we have our clean breakout retest, and then we continue going. Okay, but you can see how until we had a clean breakout over here, we did have a close right here, but then we immediately came back inside. But basically, once we accept within a previous balance area, we can expect market to get choppier. So this is the conditions that I'm saying. You don't want to be getting like around the middle of valley areas. You want to be trading the edges of it. Okay, let's go into another example. Okay, this is an example actually in the stock market, just to show you something a little bit different with volume profile. This is on the chart of Tesla. You can see how we came from a very big downtrend, made a bottom here in early 2023 before it started this up move. So we had this area right here, this profile, which let me just add the histogram, pretty much from that shaded area. So what I am measuring is this move here, which was this falling channel, which, as you know, channels is a type of accumulation or a range. And you can see we had the breakout. And if you see at this profile, pretty much this price level was the point of control from this whole area right here. And then you can see that now we have come up, down. It actually gapped down here and right into this point of control. So points of control just are a way to see areas where we have the most trades, and so those tend to act as magnets for price. Here, I'm just even gonna push this back a little bit. I'm sure the point of control will be still pretty similar. So we capture this whole area right here, and you can see right there this point of control from the bottom of this move into this retracement. And we have now that price has reached this point of control, you can see it's starting to get pretty choppy right around that area. Okay, let's go look at another example. Okay, here in gold, you can see the rule number 4, where if price reacts strongly enough with a point of control of a previous area of balance, then rule number 1 can be broken, meaning that is not going to accept back in. And you can see up here, we had this mostly sideways movement here for several days. Then we had this impulsive bearish stay down, which broke market structure to the downside. And we have our naked point of control. And you can see right here, we have a very strong move up, and price, instead of starting to stay within this general balance area right here, we can see that it had a very strong rejection over the point of control and just came back into this previous areas of value that we had right over here. Okay, and going over an example of the last rule on NASDAQ, if time and volume builds up at the edge of a balance area, then we expect to see a breakout from that. We can see this here on NASDAQ, where we clearly have, in this case, we had 1, 2, 3, 4, 5, 6 days continuously where we were trading right around the 17,760s on all the highs until, and you can see how we're starting to continuously make higher lows. And then right on this last day, we have our open and an impulsive move to the upside. And we have our close through, and then that's started this whole impulsive move up. Okay, so this one is pretty much very related to what would be like an ascending triangle pattern, which in this case you can see it right here just like this, where we have, let me make this straighter, like that, where we have a clear area of resistance. Price is in this case making higher lows. We are coiling and accumulating within the top edge of this valley area right here until we finally have the breakout and then a new imbalance move to the upside in this case. Okay, that's it for this lesson. I'll see you all in the next one.